On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Morning, team. Hope you're all well. Welcome back to a new year. Hope everyone had a fantastic break and is feeling refreshed and ready to go for 2025. This will be the first episode of many from me this year. The format will be the same, so I'll be doing 2 episodes a week, apart from the odd break if I'm away on leave. So welcome back. If this is your first time listening, great to have you on board, and I really do hope you stick around and get something out of these sessions. Right, I thought I would kick the year off with looking back on 2024. There's a lot we can learn from 2024, but I just wanted to single out what I think was one of the biggest investment lessons of last year. There were plenty, as is the case every time we close the book on a calendar year, but the one that really stood out for me was the need to ensure that your investments are globally diversified. If you didn't do that, and you instead hunkered down in New Zealand assets only, you wouldn't have enjoyed the same success that you could have. The local share market actually had a great year in the end. The NZX 50 index returned 11.4%. That's above the long-term average, and it was actually the best performance in 4 years, the best since 2020. All of those gains, just about all of those gains, came in the second 6 months of the year when the official cash rate started coming down. So it was very much a case of the market flat to slightly underwhelming for those first 6 months. Then we had a pretty cracking second half of the year. Domestic fixed income was impressive too, with the NZX Corporate Bond Index up 7%. That came on the back of a 7.5% increase in 2023, which was the highest in almost a decade. That was the highest since 2014, so 2 pretty good years in a row from local fixed income. Property didn't fare quite so well. National house prices were down slightly in 2024, and the listed property sector fell 3%. And then if you left your hard-earned dough sitting in the bank, then the return from cash was 5.6%, which is okay, but probably doesn't look quite so good when you take tax off that, because all of that return is taxable because it's all income, which is quite different to what you'd see from shares or houses or other assets where there's an element of untaxed return that you get on those assets. Anyway, across the board, those were pretty solid in most cases. It wasn't too bad. But when you compare them to some international assets, that's when they start to look a little bit disappointing. World shares were up 18% last year. That was led by the US share market, which rallied 25% on the back of a similar gain in 2023. So 2 very, very good years in a row from the US market. Japanese shares also very strong last year, up 21.2%. The Aussie market across the Tasman up 11.4%, about the same as us. Europe, the UK, emerging market equities posted solid gains, high single digits. All of those returns include dividends, just like the NZX 50 does here in New Zealand. So those are all apples with apples. Looking elsewhere, outside of share markets, outside of property markets, US Treasury bonds, they were flat, and outside of the mainstream asset classes, gold rallied 27.2% last year, so a very good year from gold, and Bitcoin surged a staggering 123.5%. So there are some very, very big numbers within that group, especially for a mere 12 months. And when you account for the currency moves, it really does rub salt in the wound. The Kiwi dollar fell 6.7% last year on a trade-weighted basis, so that means it declined against most of our major trading partners, all of them in fact. It fell hardest against the greenback, the US dollar, which was very strong, so the Kiwi fell 11.5% over the course of the year against the US dollar. It fell from 63 cents to 56 cents. And what that means is that American assets, whether it's shares or something else you own in the United States, American assets in New Zealand dollar terms were stronger still because they went up in their own right, and then you also got that currency currency translation that increased their value in New Zealand dollar terms. So US shares, the S&P 500, wasn't just up that 25% in New Zealand dollar terms, it was up 41.2% last year, which is just amazing. The Kiwi dollar was also down 10% against the British pound. It was down 5.6% against the euro, and it was down 2.5% against the Australian dollar. So all of those moves supercharged the returns from share markets in those regions for New Zealand investors, assuming you own them on an unhedged basis. If you put them in a fund, maybe your fund manager will have hedged out some of those currency moves, so you might have not got that full pickup. I don't know the answer to that. You would have to talk to your advisor or your fund manager to find out how they've structured your portfolio. But if you simply own the S&P 500 index or Microsoft or Commonwealth Bank across the Tasman, you would have benefited from not just those share price moves, but the currency moves that have gone your way as well. That won't always be the case, but last year they were very, very lucrative for local investors. So those moves would have pushed the annual return from the likes of UK shares, European shares, Aussie shares, pretty close to that 15 to 20% return zone. So they look even better than those numbers I quoted earlier on in this session once you make those currency adjustments. So whether it's houses, shares, or commercial property that spins your wheels as an investor, the lesson is the same. If you had too much, or worse still, all of your capital in local assets, you have done yourself a bit of a disservice. It's true, 2024 was just 1 year, and New Zealand won't always be the laggard. After all, in the decade leading up to the pandemic, local shares outperformed international markets on 7 out of 10 occasions. However, we've really fallen behind as an economy in recent years, and we've struggled more than most. So as workers, as employees, as homeowners, and as small business owners, there's not much we can do about that. All you can do really is stick it out and hope that things will get better. And I think they will. But for investors, you don't face those same constraints. It's never been cheaper, never been easier to spread your wealth far and wide across greener pastures. Looking back over the last 5 years, the numbers are also quite telling. The NZX 50 is up 14.1% these past 5 years, and house prices are up 24%. Now that sounds reasonable when I put it like that, but when you work that out on a per annum basis, the returns of 2.7% and 4.4% are much, much less inspiring, aren't they? Meanwhile, US shares have almost doubled over that period, the last 5 years. The Japanese market is up 80 or 85%. Australia and Europe have returned about 45% each. So if you've been hunkered down in New Zealand assets only in recent years, the gains that you've left on the table are quite significant. Now, we live in a fantastic country, and there's definitely a more prosperous period ahead for us, but there's no need to be all in. The mobility of your capital, the ease with which you can put it here, there, and everywhere, you're not just locked into having it here in New Zealand. Your capital is mobile. That means that the world is your oyster, and investors really should take advantage of that. It's a huge advantage that share investors have over property investors or farmers or homeowners who are sort of stuck with these assets they've got here in New Zealand. It's much, much harder for them to diversify into other parts of the world, into other markets that might be doing better. So you've got to make use of that. These last few years and 2024 are an example of why. Thanks for listening. We'll talk again soon.
For more insights, visit craigsip.com.